In this video, we're going to show you how to calculate what most investors refer to as the two most important metrics in evaluating an investment property to build more freedom and flexibility while creating generational wealth through real estate. We're talking about cash flow and cash on cash return. Let's start by talking about the importance of these two metrics, followed by an example showing you how to do the math in determining if a potential property would be a good investment or not. So when it comes to a rental property investing, your cash flow is the net amount of money that either piles up or disappears from your bank account each month. This tells you if your property is an income generator or a money pit. Let's say we're evaluating purchasing a duplex that was fully remodeled with permits by a general contractor who we've worked with in the past and got the thumbs up from them that it's in great shape. Let's also say this current property is listed for $600,000 and has two long-term tenants with great rental history, each paying $1,800 a month for a total of $3,600 per month. Calculating a rental property's cash flow is relatively a very simple process. First, we're going to determine the gross income from this property. Now, this can include anything from rental income, such as this $3,600, or you can also implement other creative ways to generate additional income, such as laundry service, storage, pet rent, parking, and so on. For this example, let's just keep it very simple and say it's just the tenant income of this $3,600 a month that is currently coming in. Next, we're going to deduct all expenses as well as debt service relating to this property. Now, this is where investors differ a bit in what they include in their calculation. I've seen some that keep it very, very minimal and simple by just subtracting the mortgage, the property taxes, and homeowners insurance. But what I would do is encourage you to take a bigger look at potential expenses that could come up a little bit later down the road. Property management is one example. Now, if you just have one rental property, chances are you might want to manage this one by yourself. However, if you're looking to expand your portfolio down the road, considering property management in your expenses is a great idea. Vacancy reserves really depends on the location and risk tolerance. Vacancy meaning how quickly can you turn over tenants once they leave the property. Repair reserves is money that you set aside in case something happens, like the fridge breaks down, you need a new stove, the furnace needs to be repaired, whatever that is. And this varies largely on the condition of the home as well as your risk tolerance. And then there's other items to consider, such as utilities, HOA, and lawn maintenance that may or may not be applicable to any given property. Now, when I add up all of these expenses, they total $2,600. So to get to the cash flow, you simply take the monthly income, this $3,600, and you subtract all of the expenses. So for this example, when we do that, we have a cash flow of $1,000 per month. You may have heard this before, but cash flow is king. Having sufficient cash flow is essential in keeping your real estate business afloat. Investing in rental properties with positive cash flow is the top goal for most investors, and the more cash flow you earn from each property, the bigger safety net you have and the more income you can earn. So the next calculation is cash on cash return. Now, cash on cash returns is important when evaluating the potential profitability of a property. This formula is a great way to determine how an investment will perform and ultimately help you determine whether to invest or not and how to maximize your annual returns. So by relying on cash on cash returns as a comparison, investors can get a consistent look at the long-term potential of multiple assets, as well as to measure the performance of their current assets and their portfolio over time. So let's map it up using the same duplex in the cash flow example. Referring back to the duplex that we were analyzing in the calculating cash flow, it had a $3,600 per month rental income, as well as $2,600 a month in expenses. Now, the first thing we need to do in calculating our cash on cash return is to understand what the annual pre-tax cash flow is. We simply get this number by multiplying the monthly cash flow amount by 12 for 12 months. So in this example, we take the expenses of $2,600, we subtract them by the monthly income, which equals $1,000, and then we multiply that by 12 for 12 months and end up with $12,000. Next, we're going to calculate all of the purchase costs. Now, this can be anything from your down payment, closing costs, to upcoming expenses that you might need to make on this home in order to make it rental ready, such as replacing appliances or other repairs that the home might need. In this example, because the contractor did a phenomenal job fixing up that home, it is totally turnkey and ready to put tenants in there as soon as we close. So the only expenses we have in purchase costs is just the down payment and closing costs. Now, once we've identified these two numbers, to calculate the cash on cash return, we simply divide the annual cash flow, this $12,000, by the amount of cash invested, which is this $120,000. And in this example, we come up with 10%.
So what should your cash on cash return be? Well, there is no specific rule of thumb for those wondering what constitutes a good return rate, but there seems to be a general consensus amongst investors that projected cash on cash returns between 8 to 12% indicates a very worthwhile investment. In contrast, others argue that in some markets, like the greater Seattle area, 5 to 7% is acceptable. At the end of the day, it's what makes the most sense for your portfolio. Personally, I would acquire a property producing $1,000 a month in cash flow with a 10% cash on cash return all day. So a couple of great resources I'd love to share with you are retometer.com for helping determine what the average and median monthly rent of a specific area is, and biggerpockets.com, which is a wealth of knowledge for real estate investors at every level, and where I personally began my real estate journey and saved $30,000 by following the advice of Brandon Turner instead of investing in a how-to course with a former HGTV star. True story, for another time. They have some very easy to use calculators to help you evaluate rental properties. It's a great place to start and practice. So congratulations, you're well on your way to your first or next investment property and setting yourself up to have a life with more freedom, flexibility, while creating generational wealth. I'm Nick Chambers with Chambers Northwest, a Windermere team. Thanks for watching.